with a lot of what happened in the fixed income space this summer, there were questions about how ETFs work and are priced within those events. And I actually would say that, contrary to some opinions out there, ETFs worked sort of exactly how you would expect them to. And the key understanding and difference, if you will, of ETFs versus, say, traditional mutual funds is that ETFs externalize the transaction costs. And if you have a market that becomes less liquid, harder to trade, and there happens to be flow in one direction, say redemption of fixed income securities generally in the marketplace, you're going to get an increase in transaction costs. And what that means is you'll see bigger discounts in the case of a lot of people selling fixed income investments. Now, what I would say is I think ETFs shouldered way too much of any blame for what might have been happening in the marketplace, because traditional mutual funds in the fixed income space are on the order of 8 to 10 times as large in terms of both assets and the cash flow that we were seeing and redemption activity in, for example, June of this year. And so, you know, it wasn't ETFs causing any dislocations. There were a lot of different sellers, of which ETFs were only one, albeit maybe somewhat the most visible because you could see trading volume on a regular basis. But I think it's important just to recognize that it's that externalization of transaction costs. The ETF investor is paying their own freight. And that was what we were seeing. When those costs increase, it showed up in the form of discounts and will show up in premiums if there's net buying activity in the market. I do think there are potential buying opportunities when you're going, say, against the flow in the market. So if you are providing liquidity to somebody that wants it, you're going to be able to extract a bit of a liquidity premium. And so if you were buying fixed income when everyone else was selling it, you were actually getting it, if you will, a little bit on sale relative to what you could have gotten otherwise. So there are opportunities to think about trading against the flow of the market, where you might be selling when there are premiums, you might be buying when there are discounts, reflecting the overall transaction activity in the marketplace. And it can be a way to think about investing and reallocating funds.